Hey, folks and folkaroons and traders and traderettes. This is Greg McLeod from the Elite Traders University and the Forex Cash Machine, and we're going to start our Forex Cash Machine Bulls versus Bears market outlook. My name is Greg McLeod. I'm the trader and CEO of the Elite Traders University, and this week we're going to discuss the various currency pairs, indices, and also gold, silver, and oil, in which we will look at the week ahead as far as planning, as far as looking for directional bias and how to trade these volatile markets. Markets have been on fire lately. This massive drops in the Dow futures, down almost 1,200 points, and just a lot of mayhem. We also saw like a 30% drop in oil, and we'll talk about that as well. Before we get started, I want to direct your attention to the risk disclosure on your screen. Make sure you understand all the risks associated with foreign exchange trading, and we'll go ahead and get started. I also want to, for those of you who are just brand new to the telecast, I want you to know who I am. My name is Greg McLeod. Again, I'm the founder and CEO of the Elite Traders University. We're a premier education and teaching organization to help people become better traders. And I've traded 23-year trading veteran. I've traded options, futures, stocks, forex, and crypto. I'm one of the foremost authorities of short-term day trading and scalping. I spent 8 years as a currency analyst in one of the largest forex brokers in the world, and also worked at a top-tier bank, and 16 years in the public education sector. I'm also a published author and worldwide speaker, and I've trained thousands of students worldwide. I'm the creator of the Pip and Run forex scalping system and the Trend Spotter indicator. So I am uniquely qualified to help you achieve your goals if you ever want to go deeper into trading as a profession. Okay, so let's get to it. Let's go to our charts and take a look at what's going on in the news and some other things. I'm going to go call some of my favorite tools. We're going to go to My Market Heat Map. My Market Heat Map is that's a trader's buddy, is a trader's best friend for actually getting a big overview of the market. Be able to look at 71 different instruments, including gold, silver, and oil, and crypto, and you'll be able to see that from our unique screen, being able to see dynamically moving tiles to help you get a better pulse of the market. Let's go ahead and log in. There's other tools in there as well as our charting and things like that. So we're going to go ahead and log in, and hide your eyes as I go ahead and log in to take the pulse of the market. And what we're going to do is we're going to take a quick look at my Forex heat map and see what's hot, what's hopping, what's popping, what's dropping, and what's not. And we can see from these dynamically changing and flashing pairs that are arranged, these instruments, we can see that we have the Euro Aussie and the Yen basket at the top of the heat map, along with the Euro Kiwi and Pound Aussie and the Dollar South African Rand. At the bottom of the heat map, we see trending downward. We see Aussie Yen in the last spot, Kiwi Yen, and Turkish Yen, as well as the Pound Yen, CAD Yen, and Aussie Swiss. And we can see that the Yen and Swiss franc are safety plays in which we see money flowing into those safe haven assets. As we can look at the larger, broader market, looking at our equity indices, we can switch to that heat map, be able to see what's going on there. We can see that the German market, the Australian and Japanese markets are all down pretty big, down 2% to 3%, and the German stock market is down almost 6%. The DAX is down, and the Dow Jones and futures, we're looking at that there's going to be down pretty big too, down 144 points. So let's go ahead and take a look at the news calendar up for this week. News is a great driver of currency rates. We can tell where the party is going to be. We can go right to our trader tools. We can go to our economic calendar, and in the economic calendar, we will be able to see what is actually going to be hot, and I can actually filter. I want to filter these to our high impact items only, and move the low impact ones, and then go ahead and save. And also we've got some other things here. We want to eliminate some of these other currencies that we normally don't take a look at. and that way we can have a better view of what the market will do for this current week, so we can better plan and be able to anticipate what's going to happen next, as opposed to being surprised by the market. The market has a tendency of surprising us, and with the coronavirus out, creating a lot of fear in the market, a lot of instability, and also, we have North Korea just launched some rockets or some unidentified projectiles, and that's also adding to the mix of instability and insecurity. We can see a lot of things going on. But for this week, starting March 9th, 2020, we see Canadian building permits are going to be out in the next 6 hours. The previous number was 7.4%. We're looking for a consensus of 2.3%. And so the Canadian dollar will be in play. We'll also take a look at the consumer price index from China will be out as well the following day. 5.4% was the previous number. Looking for a consensus of drop to 4.9%. And that decrease in, we see the Canadian dollar drop profusely against other currencies. Canada is one of the third largest suppliers of oil to the Western world. And with the OPEC breakdown, there's a big breakdown in the negotiations between OPEC countries as far as production cuts. And we've seen that with those production, basically there's going to be a price war, a race to the bottom, where everyone's going to be able to sell as much oil as they want. And so when that occurs, we're going to see that the price of oil has been dropping precipitously. We saw crude oil down to like the $28 mark briefly before bouncing upward. Okay, but we'll talk more about oil as we look more at the charts. We also have this week, we have gross domestic product, the GDP out of the Eurozone will come out March 10th, and then we'll see that the previous number is 0.1%. We're looking for it to be unchanged at 0.1%. And then we also have the year-over-year number remaining the same too at 0.9%. We also have on March 11th, we have consumer price index ex food and energy month on month coming in at 0.2%, and the consensus is at 0.2%. We also have consumer price index year on year from the U.S. as well, unchanged at 2.3%. Then we have initial jobless claims 4-week average on March 12th, and that's the previous number is 213,000. No consensus number is given, but that's a very volatile number. And so the U.S. dollar, we'll look for U.S. dollar currencies, base currencies, to be in play during that time. We also have the ECB rate decision that's going to be out on the 12th. That's going to be huge. They're expected to cut rates from 0 to negative 0.5%, people. This is huge. The consensus number is negative 0.5%, but they're pretty much telegraphing that they're going to go to negative interest rates. They're currently at 0 right now. Zero interest rate policy, ZIRP. That's basically they're not paying any interest for holding onto money. Now there's going to be a charge for them to hold money. Really, negative 0.5%. That should be huge. That they should go negative, following the likes of China. The likes of Japan and Switzerland. Okay, who also have negative rates. And so that will be pretty huge. So we'll see how the euro shakes out. They're definitely going to be in play March 12th. So you want to be taking a look at your euro dollar and your maybe euro Aussie to see how those currencies fare. The Australian dollar, Kiwi, and CAD versus an ECB that is actually pretty dovish. March 12th also will have the monetary policy statement after that. So expect the currency to be extremely volatile on that day, and then also look for possibility of increased volatility and movement long after the announcement, maybe an hour or so afterwards. So we advise people to maybe stay clear of the trade during that time, because prices could be quite erratic. On March 13th, we have the German Harmonized Index of Consumer Prices year on year. The previous number is 1.7%, and it's expected to remain unchanged. On March 13th, we have Michigan Consumer Price Index. It's supposed to fall from 101 to 97.0, and this could be a reflection of the coronavirus and a slowing economy as a result of more cases of coronavirus showing up here in the United States, creating some fear. And how confident can the consumer be if everyone's people are becoming sick, and school closures and things that could possibly happen. Okay. Then we go down to RBA minutes. They did have a rate decision. They cut rates. So March 17th, got St. Patrick's Day coming up, and so those minutes could put the Aussie dollar in play. It's has been trending down, so we'll see if this accelerates that downward move. The dollars, in some cases, is a safety play against the peso and against the South African rand, and in some cases against the euro and the pound. It actually we see a movement away from the dollar as more cases of coronavirus show up here, and the response has been the way it's been handled here has not been receptive by the investment community. We see when there's no faith in the way certain crisis situations are held, we see money flowing out of the U.S. and flowing into safe haven assets like bonds. We see bond yields down to 0.5%. We've seen lowest rates in history, unprecedented move in the bond market as people are flying to safety of U.S. bonds and moving out of riskier assets like stocks, which had had a significant run up until like January. But as the coronavirus has been taking more of a hold, we see this crisis move into safety, and we could go negative, rates too as well, and so that would be not very good for the economy. We have the now March 17th. Also, we have the ILO employment rate out of the UK. 3.8% was the previous number. No consensus is given, and then we have the ZEW survey of economic sentiment out of Germany. And that's another high-profile item, high-impact item that could move the market. Previous number was 8.7. No consensus is given. But sentiment, anything dealing with sentiment, and it's going to deal with emotions. And you got to think that fear is going to be setting in for a lot of people. And so sentiment will be negative. And if sentiment is negative, then that's going to cause a negative movement in a lot of these currencies. We're going to see safety assets like gold, like silver, and bonds rallying. Also the yen and U.S. dollar in some cases. Now we have retail sales minus autos for month-on-month, 0.3%. No consensus is given. And we have retail sales control group at 0%. That's for March 17th. We take a look at our calendar, and we got until we just moved into the 13th probably. That was like the end of the week, and then this is actually won't be. So these are next week's numbers, okay? Well, yeah, which is cool. We actually ended on the 13th. Michigan Consumer Conference will be the last one that we deal with, and then we really won't deal with the RBA and the other numbers until the following week, okay? So we have a pretty much overview of what's going on in the markets as far as the economic calendar. Economic calendar is pretty heavy. Make sure you consult and check out the economic calendar. We're going to move on to looking at our currencies, and we're going to start with the dollar index, the DXY or the Dixie, which is a basket of currencies versus the U.S. dollar, and we'll check that out. And then we'll also take a look at the anti-dollar or the euro, which is the basically the inverse, is one of the most widely traded instruments in the world, and we'll take a look at what's going on there. And we look at the daily chart. If you can see my screen, you can see the daily chart of the U.S. dollar index. And currently we hit a high very close to the 100 mark. 99.93 was the high we had back on February 21st, 2020. And then we saw a precipitous drop down to a low of 94.86 on March 9th. And so we can see we broke below our 20-day exponential moving average, and that is a clear sign that the bears are in control for now, as we see that the response to the coronavirus management here in the U.S. and new cases coming up has undermined the support of the currency, or the good faith in the U.S. dollar. So we can see clearly a very steep downtrend. Now, where is this money going? We can go scroll on down. Let's zero in or lens down to our a 4-hour chart, our dealer charts, and we can see we had a gap down from the 95.86 level down to 95.62, and we are just in the grips of a bear trend that has started since the middle of February. We're currently hitting old support from the 13th of January, and we probably need to back out to a weekly chart because we have moved so fast. What took us probably nearly 2 months to do as far as appreciation, we've undid it in a matter of days. So moving out to a weekly chart, we do have our some fundamental targets we can look at. And we have an A target at 88.14, which is about 700 points away. But we are moving in that direction. I mean, we had scoped that out about three weeks ago, and we said that we've been topping out whole number, round number resistance at the 100.00 area, prime bankers resistance, and we see price continuing to make our move down in a stair-step pattern. We broke the levels of the 94.68 was what we're approaching. Next level of support that comes into play, 93.81. But eventually we're looking for our move down to 87.99. Now, if we have that going on with the Dixie, then we can flip around to the Euro, EUR USD. Again, one of the most widely traded instruments in the world. In its $5.1 trillion market, the largest market in the world. And we can see that we had significant bottom put in back in March, early March. We had a low come in at 1.0760. Actually, we had that low put in about January, and we've been moving straight up from there, and showing no signs of breaking down. We're up at the 114, 1.1491, and that's still looking pretty strong there. Drilling down to a 4-hour chart on the euro, maybe took a little bit of a pause after actually spiking as high as 1.1481. We pulled back since then. We're at 1.39. At 11393. Okay. So still looking extremely bullish, and it's remarkable that we're going to go into an interest rate cut in the Eurozone to negative interest rates. We're going below zero, which is a historical move for the euro, and we are in a solid uptrend given that the interest rates are not going up, they're going down. And so this is a case, ladies and gentlemen, where you actually have the value of the currency going opposite in the direction to its yield. And so we have the euro doing that. If we look for maybe for a re-entry, if there's any profit taking or a pullback, we can look for maybe a pullback to the 1.1279 area for re-entry. We are on bulls versus bears. We're looking at the euro being bullish, even in spite of a negative interest rate, the NRP, or the negative interest rate regime, kicking in this week. Let's look at the pound versus U.S. dollar right across the pond. We'll take a look at cable, and we'll look at cable. We hit a spike high near the 1.13 whole number, round number 13100. In fact, we got as high as 1.3122, and we're pulling back to the 20-day moving average at 1.3034. And we may see some little bit of a weakness because we pulled back quite a bit from that high. Currently, we're trading at the 1.3053. So we've pulled back a little bit, but still a strong uptrend. That trend looks to continue, and we could see the high put in that we had back in, this was December. December 13th, 2019. We hit a high of 1.3515. And we're at 13053, so that's about 450 points that we could see. A move back there would be pretty good. So bulls versus bears, we definitely see the pound as bullish. And given that's moving the opposite direction of the U.S. dollar, that's what we're seeing. And people are probably wondering why. We have a yield of the Fed did cut rates 50 basis points last week, and that has taken some of the luster from, and there may be more rate cuts to come, and we could also see negative interest rates here in the U.S., which has been a boon for refinancing and buying real estate. But it also shows the gravity and the deepness of the coronavirus scare, where the Fed has to step in to lower interest rates to support the economy. Okay, so let's move. We've got. If we look for an entry, if you want an entry on this to re-enter this pair, and it has run up quite a bit, so I would look for a pullback. I like buying weakness, and we can see a move back down to 1.2990, almost maybe even 1.2900. So that would give us probably another 100 pip decline or a pullback. Any type of pullback we would see, look for a rise upward from any pullback. Okay, let's keep up moving, and let's look at the Australian dollar versus the U.S. dollar. The Aussie. And it's highly correlated to the Australian dollar and New Zealand dollar are highly correlated to the S&P and Dow. And we can see that we had unlike its other rivals, the pound and euro, it has done horribly versus the U.S. dollar. We had a drop, a 400 pip drop on the open, down to 63.14 from a high of 66.50. That was a very huge drop. In fact, if we look at the heat map, the currency heat map that we have, we can actually see the percentage loss in just a short amount of time. A 1.24% drop in the Australian dollar. It's huge in currency wise. So let's go ahead and take a look. And we have with a strong rebound from 63.12, and now we're back at 65.31. It's about 200 pip rebound from there. So huge long wick candle there, down at some support, coming in at that 60 close. They were defending the 63 level, 6,300 handle, and they succeeded for now. Probably see a retest of that level, and I want to congratulate my student Michael, who bought the dip. He bought the bottom on that one, and I think he's up like 150 pips on that. Good job, Michael. And well, he's a Kiwi, so he was probably watching it for a while. Okay, so I look for a retest of that level, that 63 level. Any bounce, Manic Monday, turnaround Tuesday, we'll probably see a retest of the lows, and even a move much lower than that too. In fact, which we had it forecast. This was like very much expected that we're going to drop lower, probably into the 5900s. We need to even back out. We have to go back out to even a monthly chart to be able to see the previous levels. Yeah, I was looking for 59.97 to be tested. That was a low that we had back on October 1st, 2008. 2008 doesn't make kind of a sense there, that we're coming back to the old lows that we had back in the 2008 financial crisis. And when I was on the desk, we had these big, wide-ranging moves. The market has a memory, and we're moving some 12 years. 12 years from that famous date that we were testing these same lows some 12 years later. Now, if history does repeat itself, we should see some type of a huge rise, possibly when this, it warms up, a little bit of sunshine, and the virus kind of disappears with the heat and light, as SARS did the same thing. It was shining light on chickens, and they figure out that's how they killed the virus. So you figure when we get in a little bit warmer climate, and that we probably see a big rebound in the markets, and this will all be a bad memory. Okay. But that's why it's good to be a student of history, so you'll know when these things repeat themselves, because it was a fabulous buying opportunity at those March lows back in 2008, and we're really coming up on, institutions seem like they're nibbling on some of these stocks and some of these currencies at these lows, that these downward movements will not last, and it will provide generational buying opportunities, especially these high dividend paying stocks like Exxon, that's already paying a dividend yield about 7%, 7.3%, and it's down 32% for the year. It's like, it's doing the math. It's good stuff. Okay. Anyway, moving right along, kind of off the track here. Let's keep going. Let's look on to the New Zealand dollar right across Tasmanian Sea. Take a look at what's going on there. And we probably see some similar price pattern that we see in the Australian dollar. We certainly did. A much more severe move. We moved from the 63.03 area down to a low of 59.99. I mean, that's a huge low. This low we have not seen in probably, 10, 12 years? Yeah, we have to go back to 2008. We got to go out to a monthly chart, and we can go ahead and check that out. And sure enough, market has a memory, guys. And let me go ahead and remove all these drawings and these indicators and things from the past that I had. And we can see, in fact, now we did not reach our 2009 or 2008 low, was about 48.08 on the New Zealand dollar. And we're currently at the 0.600. So didn't quite get there. But it seems like it has some room to drop. Next level of support, the next major level of support doesn't come in to, again, about 48.50 and some change, 48 and some change, 48.50. So that's like 1,200 pips away. So we've got some, maybe it's like someone's nibbling at some support here, but there's no clear support until the 59.26. We had a support level back on August 1st, 2006, and that level was tested again on June 1st, 2004. And we're just a few pips away from that support area. So we'll see. But the bulls versus bears still looks kind of bearish there. And that's where the kind of mixed bag there, where we have the U.S. dollar rallying against the Kiwi and Aussie, but doing poorly against the pound and the euro. And this is where you've got they kind of separate. Now let's take a look at the dollar leading pairs, dollar based pairs, like the dollar. Let's start with dollar. Start with dollar yen. USD JPY is our ticker. And it's kind of a unique situation where we have two risk averse or safety plays. The U.S. dollar is considered a safety currency. The yen is considered a safety currency. And again, both of them battling together. It's a coin flip of which one actually wins the safetiest of safe plays there. And it seems like in this case, the yen has won. And we were not too long ago, we were talking about the 112.17 area, and we were able to take some profit off there. And then we see price drop all the way down to 101, guys, 101.49. Just a huge, tremendous move. Just almost from 101 to like 1,200 pips there. That was a tremendous move there. And so that takes us back to lows that we haven't seen. And I think 101. I remember when Abe, the prime minister, or Mori, they said he had a heart attack or something, went in the hospital, and then we dropped down to these levels. And then when he got better, actually the yen weakened when he got better. It was pretty wild. The market was actually rejoicing when he was dying, which is weird. Okay, so let's go ahead. And that was like 2001. So we have to go to a monthly chart to check that out. Yep. Well, actually, we were here back in 2016, 101.30. Yeah, so we're approaching, there's quite a bit of support in that 99, 92 area, and we're approaching that. The absolute low there was on June 1st, 2016. We got a low of 98.55. So we're about 360 pips away from that. But we're moving that fast. I mean, this one bar that we've had, the high and low and close, our high was 108, our low was 101. The 1 month bar is 700 pips. So that's a pretty big move there on our daily chart. And we could see some profit taking, what they call a dead cat bounce, even a dead cow bounce. So something slamming that hard and that fast, we usually get some type of a rebound that's tradable. Dollar yen, we took a look at. Let's look at dollar CAD to see a similar move. Possibly not. We had this huge oil. There's a price war in oil, and yeah, the dollar rallied against the CAD. Yeah, Canada is one of our third largest suppliers of oil, and with the oil prices falling through the roof, we had a gap. Notice how we have a gap price here. We had 31 spot 3446, then it gapped to 13546, so a 100-point gap, and then price raced to 13758. Huge move in a daily candle, and that between the low of 135.40 and the high of 37, that's about like 190 pip move. So just tremendous volatility. So we went from tight consolidation and hardly we're stuck in a range that's probably been lasting for about a year, and now we've broken to the top of that range and broke to a new high. In fact, our old high from 12/31/2018 was 1.3658, and we broke it at 137 and some change. So we did break that high, and that was what we were looking at, is some tremendous that sideways consolidation would break into a huge, massive move to the upside, and it most certainly did break in our predicted direction. Okay, so we got dollar CAD out of the way. Let's we look at dollar yen. We looked at all of our dollar pairs. Dollar Swiss is the last one. It can be kind of funky too, because again, you got two risks or safe haven plays. The U.S. dollar is a safe haven. The Swiss franc is a safe haven. Which one wins? And the Swiss franc wins. We see the Swiss franc taking the lead here, dropping down to the lows that we had back in February 2018, down to the 91 area, 91.88 or so. Our low, trying to get a low on that. 91.82 was our low, and that Friday I think we closed at 93, so about 200 pip move in just a matter of 4 or 5 hours. Dollar Swiss, and so we're testing these lows of 2018. Could we get a rebound from there? Most certainly could, but Dollar Swiss, I'm still bearish on. Pretty significant low, but our all-time depegging low was 82.84, and that's when the Swiss National Bank broke the peg with the euro and didn't tell anybody, and so we had this huge drop. And that low was never tested, and usually lows do get tested, but that was 2015. 5 years later, we have not gotten back there yet. So I think this price has been working its way, trying to work its way back there. It will see significant demand coming in at 91.50 and at 90.75. But after 90.75, ladies and gentlemen, there's just a huge void, a gap in price, where once we breach this zone of 90.63, we could see a continued slide in dollar Swiss. Again, we're looking for a retest of the 82.91 area. Probably not going to happen overnight, but it could, as fast as these markets have been moving in spite or in the face of this coronavirus. North Korea launching rockets, and then you have this whole OPEC breakdown. So we're living in very, very interesting times to trade, and it's the volatility that we've been looking for, because volatility, ladies and gentlemen, has been clearly dead. You can see that we've been moving in a sideways consolidation in dollar Swiss since 2016, and we finally just broke out. So it took us 4 years to break out of this, and so you're here with me, and it's good to be able to relate this to you, and hopefully be able to trade this to your advantage. Okay, let's take a look at the commodities, and then we'll look at the indices, and we'll wrap things up here. We'll look at XAU USD, and usually when we get into geopolitical unrest, our gold, our Mad Max kind of things, gold, silver, hard assets start to rally as well as people become very fearful. And we did see gold tag the 1,700 per ounce level. That was on March 9th. We've backed down to the 1667 area, uptrend, higher highs and higher lows, and I think we work our way back to the 1900, 2000 area in gold, and we're in a clear uptrend. We might see some pullbacks along the way, but I think our next stop, we're looking maybe at the 1754 area and the 1800 round number that we saw back in 2013. And ultimately we'll probably get back to the old high that we had in 2011 at about the 1900 area, 1900 per ounce and beyond. So it depends on if the coronavirus continues through the spring, through the summer, that we could see a rally like that. However, if we do see a resolution in it, we could see gold sell off precipitously and see some of our safety assets go back, unwind as well. XAG USD, take a look at that's our symbol for silver. And it's our cousin of gold. Moves in a similar fashion, but it has not been moving as fast. In fact, we had a huge drop in silver. We dropped from the 1759 area down to 1660. So we're actually retesting some support that we had back on December 9th. We had some November 13th, and also the end of February. We're testing some support here. So this support might be used as a launching pad for price to move higher. I'm probably mildly bullish on silver, given that we are hitting this level of support. We've tested it 4 times, and so we can see a rebound from 1662 area and see a move back toward 1960 with the highs we saw back in September 4th, 2019. So it would be a very low risk play. You put a stop below that 1610 area and look for that move, because we're trading right against support. And those are areas that we like, low risk, high possibility entries we like to take. Okay, let's take a look at the SPX 500. Let's take a look at our index that we like to take a look at. And the futures are down huge. We can take a quick look at the pre-market. And CNBC is a good place to look at that for the pre-market. Sometimes that pre-market can be really scary to look at. And after the U.S. election, we had like a 700-point move down in the S&P. And then we saw a complete turnaround by the morning. So let's take a look at the pre-market. So Dow futures tumbled 1,200 points. Treasury yields plunge amid oil price war. And that's, I see you got 1211. It's still down, 1211, 1205. So it's down 4.67%. S&P futures down 145 points, down 4.89%. Nasdaq futures down 410, down 4.82%. And oil is down below $30 a barrel, guys. Down $11.95. Big one-day move. I mean, the day hasn't even really, it started over in Asia, but it's down 28.95%. And the 10-year Treasury yield is down at 0.53%. So imagine that. Pretty wild stuff. S&P, I mean, we have just totally taken out the lows of August, and we're down at 2818. We had Fibonacci 50% support at the 2850 area, and we got a bounce off that. And I was telling people that this is probably, if you need to liquidate your portfolio, get out and then rebuy it back in the bottom. That was a, if you got that, that was pretty cool. I was able to scalp it up, but it definitely was not holding anything long because we have a lot more, maybe a lot more to go. The market's basically downsized $2 or $3 trillion in market valuation. We're hanging at the 50% Fibo, comes in at 2857. If we take the low, actually the low we had back on, say, December 2018, we're down about 50% from that low. 50%, and there's lots of support that comes in there, and we just kind of broke that low. We could stage a rally from here. The 61% retracement is what I'm looking at. That's a key Fibonacci support level. 2729 looks very tasty. We might anyone that's bottom picking or buying the bounce, their pain threshold may get tested down at the 2716 area. Now the Fibonacci of last support is 2552, and we haven't been there since 2019. Actually, that's where we started. The year at January 3rd, 2019. I'll start last year, actually, 2525. And that is our 78.6%. Call that the Fibonacci of last resort. Now, one last level that we could hit is the down to the, I guess, 100% retracement of that low that we had, that big bottom that we put in back in December. 2324, that could be the target that they're going for too. The total rise that we've had in the markets has been totally unnatural. So a lot of these cycles and things that normally would occur have just been blown out of whack. By seeing now, we're seeing this kind of recalibration. And if we do see a full recalibration, 2324 in the S&P is probably the place where the smart money is got a bunch of buy orders there on the S&P. So, and then it would line back up into our normal wave analysis, and then we could probably see 3,400 or beyond on the S&P. We just have to get things back into order. So this is all part of normal reordering of the markets. So don't panic, but I wouldn't be a buyer here. Okay. So bulls versus bears, S&P 500, bearish here. Bearish all indices, and are very bullish the yen, very bullish the Swiss franc, and pairs like the pound Aussie, Euro Aussie, those look very tasty for the upside as safety plays. Okay, and so that should wrap us up. If you have any questions, make sure that you go ahead and pop them in the comments section. Click like and subscribe if you like this, and pass on to a friend. We'll talk to you soon. It's Greg McLeod from the Forex Cash Machine and the Elite Traders University. Talk to you soon. Peace and pips. Cheers. Peace.
Well done, my friend. Well done.
Thank you.
I couldn't help.
If you felt a spark here and want to see how these principles can be used in your own trading, go to www.elitetradersuniversity.com/apply to book a free session with our team. We have helped hundreds of people remove the frustration and obstacles in trading to become consistent, highly profitable traders. These are proven principles that just work. Happy pipping!